Hi, my name is Jacqueline and welcome to our brand new series, SRI Conversations. Now, we're currently in the midst of an inflation and there's also been talks of an impending recession. It's probably happening in the next year or two. Recently, the Fed has also made its biggest rate hike since 1994. Also, earlier this month, there was reported in the Straits Times that an MAS survey has analysts forecasting the overall inflation rate for 2022 to be up to 5% this year instead of the previous survey where it was stated to be 3.6%. That's why I have with me today two of SRI's managing partners, Benson and Ken Low. Hi, and thank you for joining me today. Hi. Yeah, so today we'll be finding out how inflation is affecting the current property market, also what we can expect if there's really a recession coming up, and basically find out just how resilient the property market is in Singapore. Is it just a bubble that's waiting to burst? So yeah, I'm just going to jump right into the questions and ask, do you think a recession is likely to happen? And also, how do you think the market will hold up then?
In general, Singaporeans, we have a lot of middle class and we call ourselves the sandwich class anyway. A lot of sandwich class and the mid-upper tier class people. Most of us are all quite educated when it comes to financial instruments. So with that, they would usually be exposed to stocks. They will be exposed to bonds, insurance, and for the younger ones, they have crypto as well these days. Then you have this very strong asset class which we know as real estate, right? Singapore citizens firmly believe in the local real estate market. Let's say a bad thing is going to happen, like say a recession or a black swan event. When it comes to liquidity of the funds, the first thing that we'll be thinking of is to offload assets like stocks or bonds, insurance and crypto altogether because they are quite liquid. And it can be divested very quickly, and you get your money maybe in a T+2, T+3 settings. You get it in 2-3 days time. But when it comes to assets like real estate, right, or if not your own home, your property, at the end of the day, it takes a bit of time for you to actually do your divesting properly, and it needs proper planning. Real estate probably is the last asset class, or rather the last thing that most of us would be thinking of selling. Properties that we will have for a family household usually is one, and for the more privileged who has a husband having a property and a wife having a property, having two, it's already so difficult to purchase, it's already so difficult to acquire.
Thanks for sharing. And how about Ken? How do you think the market will hold up then?
I think this speculation of recession happens on a very regular cycle basis. Because the coffee shop talk is every 10 years we will always see a recession. So that means in the midst of every few years you'll probably hear speculations of recessions coming in. I think more importantly, we know recessions come and go. They don't last a very, very long time. I think what we should be looking at is, based on historical data, how fast can Singapore recover from a recession? Because if recession is coming, it's inevitable, right? But if we can look at how fast the recovery can be, then it will actually determine whether you should take whatever action you should be doing, right? So if we look at the historical data, Singapore's recovery has improved over the years. It was as long as 4 years during 1997, all the way to 2 years, and the most recent one in your global financial crisis, the Lehman Brothers, we took only about 4 quarters to recover from a so-called global recession. And then of course with the recent 3 years when we are into COVID, we can evidently also see how the government is very reactive with their policies, their tweaks. They're super fast. I think they have learned a lot of lessons from the past. With pandemic, we have seen a lot of different policies coming up to insulate the market. So even if there's a recession coming, I think this morning we just really gave a quick call to one of the economists in Singapore. Their own prediction is that if there's a recession coming back, this time round with the knowledge that we have, recovery may be just in 2 quarters at most, 2 to 3 quarters, we should see a recovery in that sense. So if that's the case, then I think when we talk about this topic of a pending recession, more importantly is we see how fast we recover, because any purchase in property is no longer a speculation, no longer a speculative purchase, right? It's no longer a 1-2 year purchase. the government has already set in place a minimum holding period of 3 years. So we are all entering on a mid to long-term stand, which means that any holding of property would be able to ride past any pending recession, looking at the recovery data.
Okay, that's a relief to know. But how about current inflation now? How is it affecting the property market?
For now, we can see a lot of GLS plots that's being bidded and have been won as well.
Yeah.
So there's a certain base price when it comes to the land price on its own already. And we already know that in terms of construction also as well, ever since COVID, after coming out from circuit breaker, all the costs have been going up really much. They still have construction crunches when it comes to the workers and when it comes to the materials. And all these costs when it comes to land costs, when it comes to construction costs, everything is so transparent in Singapore. And generally in developers, in terms of their margin as well, it's usually a single digit or a high single digit usually in terms of margin as well. So pretty much even the consumers can predict how much the developers would be selling in terms of when they are launching the product per se.
I wouldn't say that inflation is the cause of rising housing prices today. It is a part of it. We used to use construction costs at about $350 per square foot to calculate how much developers will have to pay. Today, we are taking a higher benchmark of $450, right? So it's $100 per square foot difference. But on a larger picture, I think there are so many other factors that will affect housing prices in Singapore. So inflation is definitely one small portion of the whole thing. But I will also say that what is driving prices up in today's market is actually mainly on the supply. So we have always been telling consumers that supply is the key indicator to how prices will move. So of course, coupled with the inflation, higher material costs and everything, it has led to a higher new price point forming up in Singapore across every single segment, all the way from HDB as the fundamental to the luxury product. But of course, that being said, we also tell consumers that although we are in a thriving market, in a bull run in the real estate, but the market is still a bit fragmented. So if you dive deeper into things, you will still be able to spot opportunities in various segments in the market. But of course, we don't have time to talk about this. But anybody who is listening to this can speak to SI Realtor because they are all trained to spot such opportunities. Yeah.
Okay, and also there's been talks about rising home loan interest rates. Now, I know for now there's the highest fixed rate is at 2.6%, and there's also been talks that the interest rates will rise up to 3%. So how do you think this will affect the homeowners here in Singapore?
I think if we take an indicative of the interest rates now, the floating rates are running at about 1.2%, the variable rates, but the fixed rates are running, like you say, about 2.5, 2.6%. All this while, we don't see such a huge disparity between two types of rates. Only recently, the past few months, we saw the fixed rate starting to pull apart. I mean, the fixed rate is actually a very clear indication from the banks on what they are predicting the floating rate to become by the end of the year, right? So, based on the economists that we spoke to, the bankers that we spoke to, we are expecting interest rates to all hit up to about maybe 2.5, in between 2.5 to 3% by end of the year. So of course, a lot of people looking at the percentage increase, they will be afraid because they will feel that it's doubled. So we did a very quick case study on that. On a normal term of a 1.8 million purchase price, if it's based on a 1.5% interest rate, your installment is running at about $4,600 per month, right? But if the interest rate goes up to 2.5% by end of the year, your mortgage actually doesn't double. It only increases up to about $5,300. So the differential here is about $700 in terms of monthly installment. And like what Benson mentioned earlier on with the middle class and the upper tier people, if you can afford a 1.8 million property, then I believe $700 will not have a big burn in your pocket in that sense. But of course, now we talk about the 80% of people who are holding on to HDB and how would this impact them. There will be a portion of them who are already running on HDB loans. And HDB loan interest rate is already at 2.6% all this while, right? But of course, those who are running on private loans, they will expect to see interest rates rising. But because HDB quantum is a lot lower, then of course, based on that, proportionately, your impact is a lot lesser. So, So I don't think interest rates will have a very huge impact because we have been enjoying and spoiled by low interest rates for the past 2-3 years. 1%, 1 point something percent, or even lower than 1% is probably the lowest interest rates in the world, right? We have been spoiled by this. Now actually we are just normalizing. I don't think we are seeing an increment of interest rate. We are just normalizing back to normal pre-COVID days. So I think the market should hold pretty well with these increasing interest rates.
It's something which I realized that on a macro level, right? If you think about it, what really happened during circuit breaker? Now, it's unprecedented for sure. Circuit breaker is unprecedented. You have situations like this and that the government, or MAS rather, actually speaks to the banks and asks the banks across the board to make sure that everybody is allowed the chance to roll your interest and your principal for a year in case with no reasons asked, which means whether you lose your job or not. When MAS actually does that, it simply means that they worry about systemic kind of situation where the market actually crashes.
Yeah.
So the government is really quick enough to react when it comes to such situations. So I'm assuming if, let's say, a recession really comes, I'm quite sure they are ready for it also as well.
And I think also one important gauge is that there's a very huge and good foresight by Singapore government. Right before in 2013, they have already created this TDSR to insulate the market, right? So, and in TDSR is calculated already based on a 3.5% interest rate, which means the market is prepared to go all the way up to 3.5%, and you can still reasonably afford the mortgage, right? And of course, in a more reactive way, in December last year, they probably already foresee the interest rate will be rising in this year, right? So what they did was, again, reactively, they dropped your TDSR from 60% to 55%. So by this drop of this 5%, they further insulate the market that you are not over leveraged even when the interest rates rises to a certain level. So like we say, government has a very important part to play, and we are in safe hands.
So do you guys have any word of advice for people waiting at the sidelines to buy their property?
For those people who are currently renting today, it makes no sense in this environment, especially when the rental trend is actually trending very high or trending on the upwards, and we do foresee that the rental will continue to increase for now. So instead of paying rental, why not just get something which you can use now and pay yourself, which means take the mortgage and pay it into your own pockets instead. I think that makes more economical sense in this instance.
Yeah.
So for those people who also at the same time thinking of actually upgrading or downgrading now, this is a very good time to sell. We have definitely more buyers in the market than sellers now. It's definitely a seller's market today. So it's a great time for you to consider selling. Even if you're upgrading and that you have to pay more, it still makes sense because everybody wants to sell high. So when you sell high, in general, you have more liquid and you can place the liquidity into your next property instead.
So I think maybe we also want to be very, very clear that if you look at Singapore fundamental, we are actually just enjoying the recovery from the pandemic, right? All the data points that we look at from the banks, we are just into our recovery phase. By right, we are supposed to run well. But of course, these talks of recessions actually come about because it's linked to US. So the real place that is going to face a recession is from the US to curb the inflation that is running haywire now. And of course, the byproduct that is affecting will be like Singapore and other countries. So when the recession is not happening within our country itself, but because we are linked to the US market, then that is the reason why we know that the recovery will be fast, because fundamentally we are strong. Our unemployment rate is low. Our almost every fundamental is on a recovery phase. So with that, I don't think buyers should be waiting on the fence for too long. More importantly is to the question of fire sale. There are so many factors when it comes to purchasing a property, whether is it for homestay or investment, right? Whether you like the size, you like the layout, do you like the level, do you like the development, do you like the area, do you like the price, do you like the unit number? So fire sales don't come in with like a 10,000 of fire sale units coming into the market at one time. It always comes out one here and there if there's distress sales. And so a lot of people say I'll wait for fire sale, but I would be very, very sure that based on all the cycles we have seen before, when a real fire sale come along, you start to think of all these factors, does it match? And then you will miss the boat, somebody will grab the unit, and then with 2 quarters of recovery, the market normalized back again, it may be hit up to a new high. So I would say, in accordance to what Benson have also mentioned, I don't think there's a need to wait on the sidelines. There are great opportunities in today's market. I think if they are really looking for home or investment, if they spot something they like, they spot something that they can afford, I think they should go ahead with their purchase.
I agree.
Yep.
Thank you, Benson and Ken, for sharing. I'm sure everyone had a lot to take away from this episode. Yeah, so thank you for your time, and to all the audience, if you made it this far in this video, we hope you enjoyed it. If you have any questions, please feel free to reach out to any of our trusted SRI salespeople, and they'll be glad to assist you. Alternatively, you may choose to leave your comments or questions in the comment box below, and we may come back with just another episode, right?
Yeah.
Yeah. So if you found this video informative and educational, please help us to like and share it, and also remember to subscribe to our channel. And with that, we'll see you guys for the very next episode. So thank you once again, and thank you, Benson and Ken. Bye-bye. We'll see you.
Bye.